Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today, we're very fortunate to have with us Brian Kessens. Brian is a co-portfolio manager of all of Tortoise Capital's active strategies, including the Tortoise Energy Fund and the Tortoise AI Infrastructure ETF. He's also a member of the firm's investment committee. Tortoise is an energy-focused investment firm that invests primarily in publicly traded companies in energy and power infrastructure sectors and has over $9 billion of assets under management. Welcome to Compound Insights, Brian.
Thanks, Gary. It's a pleasure to be here.
Brian, when you look back on 2025 in particular, what, if any, were the surprises in the energy sector, would you say?
Yeah, great question. I think the biggest surprise we had was on April 2nd. A lot of people recognize that as the day where we escalated the tariff war around the world, if you will. But what happened on that same day, and I think it was straightly a coincidence, was OPEC made the decision actually to bring back a lot of their barrels that they had been curtailing over the past couple of years at an accelerated rate. The reason we were surprised by that was because the oil markets coming into the year, frankly, did not look like we were undersupplied by any means, and prices were not overly attractive where we felt that OPEC would necessarily want to bring on additional supplies. But nonetheless, they made the move that same day to bring on more capacity, resulting in certainly a weaker crude oil price environment. And that kind of soured at least the energy sector starting there on April 2nd.
And Brian, you've been with Tortoise for over 15 years. In that time, how has the firm's investment approach or process evolved?
Yeah, it's been really consistent. The name Tortoise is no accident. Our motto is steady wins. We have a process, three-step process. First one's very qualitative in nature. We look at the assets, the stability of the underlying cash flows of the management team, and then what and overall is the stakeholder alignment. As our financial models come into play, we look at growth and what are the key drivers, maybe what are the downside risks that might be hidden within companies. And then our last view that we look at is valuation. And that's really a time-tested approach that when I started at the firm in 2008, we had in place and really haven't changed it all that much. Some things we emphasize more at different points in time than others. A few years ago, we were emphasizing stakeholder alignment more so than anything else. But largely, that process has remained intact and served us really well.
And given your tenure, you've invested probably through many energy cycles in your career. Is there anything that sort of feels different about today's energy cycle and sort of any lessons to take away from that for investors to how to net to how do they should navigate the sector?
Very much so. When I started, my energy career was back in 2004, really at the genesis, or it coincided with the start of the shale revolution. And at least in the US, from an energy perspective, that next 15 years was really all supply side driven. The US more than doubled our production of crude oil, and natural gas liquids throughout that time period. And it was all supply driven. We had more production. We had to get it to the markets, not only domestically, but then we actually started to export really all of our energy commodities as well, starting in 2016 with natural gas, with liquefied natural gas. But then we started to export ethane and some of the NGLs, and then even exporting crude oil, which 20, 25 years ago, you would have never thought we would have actually exported crude oil out of the US. The environment we're in today is very much different, where certainly we have had all of this production or the supply growth, but now from a supply side tailwinds, we really have demand side tailwinds, and that demand is really coming in the form of electricity demand. Where over that same period, electricity demand or load growth averaged about 0.5% on an annual basis, and now because of some onshoring, um, with LNG exporting, we have more natural gas demand as well, and then with data centers, they're really driving a step change in the amount of electricity demand that we and others are forecasting needs to take place over the next 10 years. In fact, we think that on an annual basis, that half of 1% is going to go to about 3.5% annually over the next decade. And that's really a step change for not only the energy sector, but even more specifically, I guess, for those utility executives who are seeing all these new demands placed upon them.
And given that evolution, do you think there are aspects of the energy sector that are sort of underappreciated or misunderstood by investors in the current environment?
Yeah, I think that is very much one of them, is that I don't think it's appreciated the actual amount of electricity demand and how that is growing. It's easy to say we're going from half 1% to 3.5%, over a 1 year time period. That feels pretty good. But the cumulative impact on that 10 years from now is really transformational. We went from, before saying, you know what, do we really need to build a lot more generation in the US, given we are becoming more efficient in how we use it, to saying, even saying, do we even need to use coal-fired power generation anymore? Should we displace coal entirely and replace with natural gas or nuclear, or even renewables, something else? And the step change now that we have to appreciate is that we need all of the above, and we need all of the above and more. Not only do we need renewables to grow, we need natural gas-fired power generation to grow. We need to push out any coal-fired power retirements that we had. And oh, by the way, nuclear is great because it is renewable. It can be base load. It's always on. It meets the reliability standards of the data centers. But hey, it takes a long time to build new nuclear. And if we want to build it, we need to get started today so we can start adding new nuclear for the most part, 10 years from now in 2035. And I think all of those things and all of that change is happening, over the course of, like, 12 to 24 months, is really hard for anyone, let alone investors, to kind of get their arms around all the ramifications of that.
And we're looking now, we're in 2026, and you've just sort of laid out a whole bunch of different changes. What are the key investment themes to build theses around, and what data points should we track to monitor progress or validate the thesis?
Yeah, we think that natural gas, in particular, continues to be underappreciated. I talked about all of this load growth that we see going forward. I think there was a view that, renewables are increasingly becoming cheaper, and that renewables can fit nearly all of this load growth, can meet all of that. But frankly, renewables are not overly reliable, and the hyperscalers or the data centers want what's called five nines reliability. They want the electricity to be reliable 99.999% of the time. And the sun doesn't always shine, the wind doesn't always blow. So we certainly need renewables, we need them to grow, but we need more than that. Then there was a view that, hey, nuclear can potentially resolve this. And by and large, in theory, it can. Um, but it takes a long time to build new nuclear. And we did, recently, mothball three nuclear power plants. We can bring those back online, and we can have more uprates, or utilize the existing, nuclear that we have in a more efficient, or higher utilization way. But that really only adds about 4 gigawatts, and we're talking about a need of over 100 gigawatts. And I think that that's where natural gas comes into play. In the US in particular, it's abundant. It continues to be relatively inexpensive. Frankly, the price seemingly is more weather driven, than necessarily demand focused from other areas, especially this year so far. And we think that natural gas in particular has a big role to play in this, and that in it particular continues to be underappreciated. In addition, as it relates to natural gas from the US, the rest of the world is growing its energy needs as well, for sure. And the US is already the world's leader in the export of natural gas through liquefied natural gas, or LNG. And our LNG facilities, we continue to build one more of them, and we continue to expand the existing ones. And our LNG exports are largely going to double between the end of 2024 and the end of 2027, which also is a pretty big change for the natural gas environment. What we're watching, all the stepstones along the way, is a natural gas demand increasing the way that we generally think it is going to. And then we're asking, where is that additional supply, going to come from? Which shale basins are kind of the most economic in the right proximities to meet that new demand?
And you just touched on it, data centers. There's some debate as to whether we're sort of overbuilding. I mean, where do you come in on that? How do we sort of gauge whether or not we're sort of building the right amount of demand?
Yeah, it's a good question, because CapEx does continue to go higher for the hyperscalers, where they're seemingly trying to compete with each other, to have the best AI bots, if you will. I think what's hard for anyone to get their hands around, us included, is, data centers say they want to build all these data centers, but in reality, they are not going to build all of them that are necessarily being planned. They're just trying to scope out different locations for what's their proximity to power, what's their proximity to other connectivity, what's their proximity to water, and then where can they kind of get the best deal from whatever jurisdiction they're looking to build in. So, all of the ones that appear to be planned, we know that they're not all going to be planned, but we're trying to position ourselves for some smaller number, but plan for where those that natural gas pipeline infrastructure is in particular. Assume that some natural or some data centers will go in and around those particular pipes.
And another potential theme, M&A, where does that fit into the narrative? And do you expect that to be part of lead to improvement in valuations in the sector?
Yeah, M&A continues to be pretty important. I think it does depend a little bit on where you're at within the energy sector. I talked a lot about pipelines and energy infrastructure. Several years ago, corporate M&A was a big part of their playbook as it related to their ability to grow. Corporate M&A was a part of that. Now, though, given a bit of the organic opportunity to grow, as we're seeing natural gas demand move higher, we need to build more pipelines or at least expand existing ones. They can see their way to growing more organically, and they don't necessarily need corporate M&A in order to grow. I do think that as it relates to energy infrastructure, there's a lot of pipeline assets that are still in private hands, and those private companies are looking to exit at some point, and they can exit through the IPO route or they can sell to an existing publicly traded company. The IPO market seemingly should be open. We think appetite is there for these types of assets for sure, but it's not nearly as robust as we would necessarily expect it to be. One, and I think that the one thing that the private sellers are looking for is to get all out at one time to liquidate their entire position, and the publics offer that. What we're encouraged by is that the publics are really only focused on those assets that are the most complementary to their existing asset bases. They're really being really disciplined with all their capital, including how they're looking at M&A. But I think that's really encouraging.
And are there parts of the energy infrastructure universe where consolidation would meaningfully improve economics?
Good question. At this point, not necessarily. We saw a lot of the economics improve with, if you will, over the past decade with consolidation, because in the energy infrastructure sector, there's two different types of securities. There's master limited partnerships or MLPs, and then there are C corps. In a lot of cases, the C corps owned a general partner of the underlying master limited partnership, and they consolidated the two entities, and in a lot of cases that resulted in improving economics. But a lot of the transactions that we see potentially today are not overly meaningful to put different sorts of assets together. We kind of went through that consolidation phase over the past 10 years, and I think we're through the easier transactions, if you will.
And AI, artificial intelligence driven growth, what could that mean for energy valuations? And could that sort of change how investors sort of view the sector and valuation methodologies generally?
Yeah, I think there's a couple things with AI. One, it is all, or what is becoming clear is that power is one of the key bottlenecks for AI. So any energy, even more traditional energy, certainly has a role into meeting that increased power demand as it is associated with AI. And AI, from our perspective, it's not going anywhere. It's only going to get bigger and bigger. Its energy appetite is only going to grow over time. And I think that investors are going to recognize that the currency, if you will, for AI is really the energy, how much energy anyone or any country can produce. And I think energy in particular will have a greater appreciation toward not only the public but investors as well in the future. And I think that can improve the overall valuations of the sector. And then secondly, the companies, let's be frank, they're using AI themselves. In particular, the producers are using AI in a lot of interesting ways. They have all this data as it relates to their drilling operations that goes back decades in time. They can feed that data into AI, and humans can always certainly try to interpret patterns, but AI can interpret those patterns arguably certainly faster and better than humans have historically. So as it relates to how long can you actually drill that lateral, how much fracking should actually take place within that lateral, should you drill multiple laterals at the same time? How can you increase the efficiencies of the overall drilling operation? How can you stay in zone for longer? All of those AI is going to help and improve the overall economics of the producers in a meaningful way.
And shifting to the macro, commodity volatility, geopolitics, tariffs, and the Fed, How should we think about those? What will those mean for the sector this year, do you think?
Yeah, you got to love energy because all of those macro variables play a pretty big role. I think the clearly the one that has been most impactful or most surprising, not necessarily in 2025, but here to start the year has been the U.S. um, and Venezuela as it relates to Venezuela in particular, and then our apparent appetite for Venezuelan oil. I think it's interesting. Venezuela historically, sort of or a couple decades ago, they produced about 3 million barrels. Today, that 3 million is down to about 1 million barrels per day, just from a lack of time, effort, and frankly, investment into their own energy infrastructure activities. Venezuela, interesting enough, actually, from a reserve perspective, not production, but their reserves are actually the largest in the world. So it's potentially very attractive for energy company to look at with the potential in Venezuela. But I think as we look at Venezuela, we're not predicting any big surge in overall or the underlying production there. It's going to take a lot of time, effort, and capital, and frankly, security or the reliability of the contracts that would be entered into for any U.S. or frankly any international company to go into Venezuela and try to reinvigorate their overall oil production. So that's something to certainly watch, but I don't think it's overly meaningful for this year. What I do think is meaningful or interesting for this year, certainly we're going to watch OPEC and their actions. And I think the one that's going to be the most telling is what happens over the summer, where OPEC's actually taken the approach that they want someone to come in and independently verify the ability for every OPEC country to produce oil. Seemingly, there's always been this supposed kind of reserve capacity, particularly from Saudi Arabia, that they have. But they're going to have actually the consultant doing it is a U.S. based company, and they're going to actually determine or have a baseline of what the max capacity is for every OPEC country. And I think potentially that's going to be surprising in that I think it might be a lot less than what the countries themselves have been saying their capacity is. And I think that the potential implications for oil prices is that the spare capacity that we actually have is a lot less than what the market assumes right now. So anything that might happen with, we're talking about the potential closure of the Strait of Hormuz with Iran, something that happens, it'll be even more impactful knowing that there's not a lot of spare reserve capacity at hand.
And we just discussed it, geopolitical risk. When you're looking about putting a position on, does that affect position sizing? I mean, how do you sort of quantify that as a risk when you're looking to make an investment?
Yeah, certainly it is a consideration, and we're always trying to look out to see what sort of geopolitical outcome might be across the horizon. We do try to take, as the name Tortoise implies, a bit of a longer term perspective, and want to understand, where we are potentially in the cycle. And once we get through a geopolitical event, how do things actually normalize out? And that's really when we make investments, what we want to understand what that more normalized view of the world actually is. And at the end of the day, despite what goes on in geopolitics, what we are focused on, particularly from a producer standpoint, or even as it relates to energy infrastructure, is investing more so in those that have the lowest cost to production on the producer side, and then on the pipeline side, who's got the highest form of fee-based cash flows with the highest quality counterparties. Those are the companies that tend to do better throughout the cycle, and that we can generally always overweight or generally hold strong positions in the portfolio.
And do you see anything regulatory or policy wise that you would consider a risk in the current environment or is worth paying attention to?
Yeah, on the regulatory side, it is interesting. It is certainly different than what we saw in the previous administrations, particularly under the Biden administration, where the regulators and policy was generally viewed as a potential threat, I think, in particular for fossil fuel types of assets. And the current Trump administration's been the opposite of that. The focus has really been on trying to streamline permitting, trying to minimize the potential delays that can come from litigation, because I think there's a recognition that we have a lot of energy. We're clearly an energy superpower, but we don't want, from a customer perspective and customer affordability, we don't want necessarily high prices for gasoline, or for natural gas, or for electricity. Consumers should pay what is a reasonable rate to be able to take advantage of the energy dominance that we do have. if you will. So we're happy to see that the Trump administration has generally been fairly policy friendly and trying to get more supplies to the markets in a more efficient way, really to benefit the end user.
Just hit on a bunch of different themes there. I'm just wondering as we hit it again in 2026, where could the surprises come from in the energy sector? Obviously, Venezuela wasn't something people thought about possibly a few months ago. What else could be on the table as a surprise?
Yeah, I think another potential surprise is what happens with Iran. If the government of Iran does feel that they're on their kind of their last footing, do they actually attempt to close the Strait of Hormuz? That's potentially impactful because about 20% of the world's oil exports go through that strait on a daily basis. So that would certainly not only surprise, but probably be the most impactful thing that we could see happening to oil markets. I do think we don't talk a lot about the natural gas markets, but they arguably have already surprised a little bit to start the year. If you go back to the beginning of December, in the first 2 weeks of December, there was this polar vortex from a weather event that happened in the US, and we saw natural gas prices spike to about $5 per MMBTU. Our view, as we've talked about, is demand, whether it's from LNG exports or electricity demand, is certainly going to move higher in 2026. And seemingly that's going to require, higher natural gas prices, all else equal. We need to incentivize the producers to continue to produce what they have, but actually to grow production a bit. Excuse me. But as we sit here today, natural gas prices are just a little over $3 per MMBTU. We're in the heart of winter. You're like, what is going on? But we've actually had a relatively mild winter when we look at it in totality, and the forecast continues to be relatively mild as well. And here we are with natural gas prices that are frankly pretty cheap right now.
And given that this is the environment that we're operating in, what's the tone of conversations? What's the feedback you get from institutional allocators? What's their sentiment?
Yeah, we see two different approaches. Our existing clients, by and large, by definition, they like energy. They recognize it for all of its attributes that we've talked about. They see the growth ahead from a total return perspective. The expectations from them are generally we're going to get the yield, which for energy infrastructure is about 5%. The growth is pretty compelling at 5 to 7%, and we actually probably get another 1% from share buybacks. So the overall total return proposition that we think you should expect this year is kind of low double digits to mid-teens. You could potentially get higher than that if energy is appreciated even more. So we have those types of conversations. And then we talk to a lot of investors that still view energy through the lens that we talked about through 10 years ago, where it would continue to, or from what it was then, which was it was generally a supply side growth story. The companies were issuing a lot of equity to grow their underlying production. The companies also had a relatively large amount of leverage. Free cash flow was de minimis. And I talked about they were issuing equities. They were certainly not buying back shares. And I think a lot of it is just an education process for a lot of investors to understand, hey, look, the sector is in a completely different perspective now, where the tailwinds are very different from where they were 10 years ago.
Let's shift into portfolio construction. If you're going to put together an energy-focused investment portfolio by sector, I mean, what would that look like? What's the rationale? Upstream, midstream, downstream, utilities, power generation? How does this all come together? How would you just put together that portfolio?
Yeah, that's a great question. By and large, we're very for what we talked about with the data centers needing more power, and that power is essentially going to be sourced by and large from electricity. Um, One, the liquefied natural gas exports. We think that natural gas has a lot of tailwinds in the future, so we're gonna build it first and foremost around natural gas. What that means from a production side standpoint is we certainly want to own the producers, particularly now where they've actually been beaten up here to start the year, given where natural gas prices have gone to $3 per MMBTU. So a name like Expand Energy, we think is great. We think EQT is really well positioned as well in the Marcellus. So we want to certainly build with the natural gas producers. We want to build with natural gas infrastructure as well. A name like a Williams, the ticker is WMB. They own arguably the most valuable natural gas pipeline in the U.S. called the Transco pipeline. It goes from the Gulf Coast all the way up the Atlantic seaboard and supplies New York City with natural gas. They have the opportunity to build a lot of laterals off of that to supply data centers or anyone that might be looking for more generation. We think they're well positioned. They've also taken the approach that they're happy to build or willing to build kind of behind the meter power that's not necessarily connected to the grid, but behind the meter power that can directly supply data centers. And we think that that is a really constructive approach to take. So we want to own natural gas infrastructure, and then we want to own utilities. Certainly, they're taking up their growth estimates. Um, from where we were a couple of years ago, their EPS growth is probably up about 2%. And in some cases, even higher than that from where we were before. We think that they have a lot of tailwinds as well. We think that the regulators, when they come and ask for things to grow their overall footprint, whether it's generation, transmission, or distribution. We think that that's generally going to be well received, yes, particularly if they can negotiate around the customer affordability issues and put most of the onus on the large scale users of electricity. So that's kind of going to be, in our mind, the core of it. Then we also recognize that there is a place for the service providers, oilfield service providers like a Schlumberger or a Baker Hughes. We think that the integrated oil companies, the Exxons, the Chevrons, and frankly the more of the oil producers have a large role to play as well. And the refiner is very cyclical in nature, but we do think they have a role in the portfolio as well. Particularly now, I talked about Venezuela um, a bit ago, but they are actually going to be able to use Venezuelan crude oil, which is a little bit of a heavier variety, but frankly, it's very similar or analogous to the Canadian oil sands. And the U.S. refinery network is kind of uniquely designed to benefit or to be able to process that heavy crude.
And in constructing that portfolio, you touched earlier on valuation, um, management. How do you sort of get, is it more of a qualitative thing? You could look at corporate governance, things like that. I mean, how do you make the call on management? What distinguishes a good management from one that like you might not be as interested in investing in?
Yeah, we do put a lot of emphasis on corporate governance, and I think that's one thing that has changed a bit in the overall energy sector as well over the past 10 years. If you go back 10 years ago, on the producer side or refining, a lot of companies, the management teams were paid to be able to grow production or be able to grow capacity. Um, and then as it related to the more of the traditional energy infrastructure, companies were paid to grow their underlying cash flow. What has changed over the past 10 years is a lot of that compensation now is tied to how well is your stock actually performing, how much cash are you able to return to shareholders. So we think overall, from a governance perspective, the sector is much better positioned. Now, there's always differences in how companies are approaching it, but first and foremost, when we're thinking about management teams, that's where we go to first is how are they compensated?
And besides governance, there's also the ES in the ESG. How much does that ES sort of factor into sort of investment approach?
Yeah, we look at it as overall, what's the stakeholder alignment? So certainly governance has a role into that as well. But as it relates to the others, the companies all have employees. Hey, are they doing right by the employees? Are they operating in a safe manner? Are they providing benefits that are generally healthy for their underlying employees? Or that is the overall climate at the company a place where people want to go to work? And then we also recognize, hey, energy companies in particular have a unique role within communities. A lot of times, um, I don't think the individual necessarily appreciates it because hey, the energy by and large, pipelines in particular, are out of sight, out of mind. A lot of times, so electric lines are also buried. That's a great thing. You do want to be able to go home and flip on the shower and take a hot shower and flip on the light switch and the lights to come on. That's a great thing. But in order to do that and make it happen, the energy companies then and of themselves have to be doing right in their own individual communities and communicate when things may be down, may be up, when repairs are going on to do them in a responsible way. And that's what we're looking for as well.
And then sort of lastly on the portfolio side, stress testing, because we discussed volatility. Do you stress test any of the portfolios or investment ideas very much? Say a sharp decline in oil prices, delays in pipeline permitting, things like that.
We do. Great question. Our financial models are uniquely designed so we can really stress test what we believe are the key drivers of the companies. So we do stress test from the producer perspective, what's going on with commodity prices. Can they, excuse me, can the producer work through a lower commodity price environment and not trip any debt covenants if they have them. From a midstream perspective, we'll look at tariffs, volumes, and project returns a little bit to your point, and stress test what but potential downside would look like and what that might mean for valuation.
And over the next, say, 5, 10 years, which is a little bit further out, what structural trends do you believe will matter most for energy investors?
Yeah, great question. I think that the structural trend that we're going to be paying most attention to over the long term is what happens with natural gas, and in particular with natural gas demand. We continue to see demand moving meaningfully up over the next 15, and 20 years. And I think that's going just to continue to benefit um, certainly not only the existing energy infrastructure, which arguably becomes that much more valuable, but those companies that can control that natural gas molecule through more of the energy value chain all the way from production to that end user. I think those companies that can control the molecule a longer way will benefit even more.
And lastly, for those of us who are sort of non-professional investors looking at the energy sector, what are the kind of questions we should ask ourselves? Obviously, our positions could be smaller. And then how do you sort of approach it if you're not able to do the same level of due diligence you are? I mean, I believe your firm has ETFs and things like that. Is an ETF a good way to just sort of get your feet wet in the sector?
Yeah, we think ETFs are great. They're an appropriate product for energy. In particular, if you're new to energy, you're not quite sure how to approach it, and maybe you don't want to take all the commodity price risk and all of the analysis that needs to do as it relates to commodity prices. We don't want to take that risk and just want to own companies that have really visible, steady cash flow. I think energy infrastructure and utilities fit that bill really well. All those companies have what I would consider a really compelling dividend, and they're growing that dividend anywhere between 5 and 7% on an annual basis. Where the pipelines are even buying back shares. Utilities, their capex, let's be honest, is going a lot higher, and they're going to earn returns on that capex, but they do need to issue equity over time. And maybe you take those equity offerings that the utility companies are doing to implement and position into your portfolio, or certainly we do so as it relates to our ETFs. But I think owning more of those stable assets that have really visible cash flows that are going to grow over time, anywhere between 5 and 9%, is a really attractive way to play energy in this environment.
Brian, thank you for joining us today, sharing your perspectives and valuable insights. And to our listeners, thank you for tuning in to Compound Insights from CFA Society New York. I'm Gary Farber, and we look forward to bringing you more conversations with leading voices in finance